watching Stock Watch. I'm Zinati Kumba, and joining me to unpack your stock-related questions today are Mutooni from Sanlam Investments and Ricus Reeders from PSG Hole in Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or an X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Let's actually start off with the JSE. It had Ricus, a little bit of a pullback today from, of course, the really great day yesterday. Are we just going to see the JSE kind of oscillating around this level for a while?
Well, I think at least till the 1st of August, as far as SA Inc. shares are concerned. Today's movement certainly influenced by a pullback in precious metals shares on the back of lower precious metals prices. But otherwise, a bit of rand weakness has led to inflows into the more rand hedged kind of things, apart from precious metals. But yeah, I think there's a lot of uncertainty. You know, last week, if I'm not mistaken, we had sort of 0.01 ups and downs in the all-share index for almost 5 or 6 days, 5 or 6 trading days. So there's still a lot of uncertainty surrounding tariffs and how we're going to be hit by Trump come 1st of August.
Okay. Well, I mean, just on the JSE as well, somebody says, I understand JSE plans opening 24 hours. When is this likely to happen? I understand that it is something that they are kind of mulling. Roy, what difference would this make?
I think there's still a little bit of time. They're definitely discussing it, but there's absolutely, I don't think there's anywhere else where they trade 24 hours.
Yeah.
Markets close and then different regions open on and on. But it would be an interesting one. I think it would integrate us closer to the rest of the world. But there's technical difficulties of doing this, the working day, how does electronic trading go and all of that. So I think there's still a little bit of time, but it's quite clear by the fact that they're talking about it, that there's already been some consideration and maybe they're trying to see how the feasibility is. But there's really been nothing officially put out there about timing, structure, or time of implementation.
Yeah, as long as they know that I'm leaving by 7 p.m. and that I'm still not working on public holidays. All right. So let's get to more questions. Richemont, is it a good time to buy Richemont shares for the long term? Actually, Ricus, is there any other kind of time period where you would buy Richemont except for the long term?
Well, it was my stock pick and it's gone totally against me. I think it's about 8 or 9% off or low since the buy. I still think of the big name luxury brands, considering their latest results. I mean, I'm talking of Richemont. They are far more resilient than most other luxury groups because of the focus they have in their products and the focus they have on their specific client group. I think the update was very good, and with I think the luxury sector having been sold down quite severely, and Richemont having held up very well during that sell-off. When that tide turns, and I think it will as we get more clarity about what's going to be tariffed and what's not going to be tariffed. I think Richemont will continue to do well, and I think at these prices it's still cheap, even though, as I said, my timing on that's been completely off.
And that's the thing, because in the short term you do get some volatility coming through if the numbers miss expectations. We've seen heavy movements on the really sharp movements whenever they disappoint on the numbers, and of course yeah, with just everything that's going on with the Chinese economy and its impact. But Roy, would you say that the short-term movements or things that affect the stock in the short term are maybe something that investors should be able to stomach for returns and fruits in the longer term?
Look, I think the investment case for Richemont is around formalization of jewelry trade. So of all the luxury items out there, jewelry has the biggest component in the informal market. Not in the non-branded market, actually. That's probably how better to describe it. And what they're doing is they're making this more and more branded. And remember, jewelry doesn't have an exorbitantly high entry point. So as the middle class, as people start working in developed markets, places like China, where people don't want big families and people are single and they earn money and they want to reward themselves, they'll keep buying jewelry. And Richemont seems to have a very good formula as to how to sell these from both a wholesale and a retail perspective and a brand building perspective. So over the medium to long term, you definitely have a case here to invest in Richemont. It's nicely balanced between Europe, China, and the US. It will always be impacted by the difficulties there are in China, and the luxury market as a whole is going to struggle at a time when economies are not growing. So you have to be prepared for the volatility, and particularly when the big giant LVMH seems to be struggling across all of its pillars. You're going to find people not wanting to get involved in the sector. Just remember, Richemont has, I think it's between 10 and 12% of its market cap in cash. It's that strong in the jewelry market. It's nicely diversified across the big developed markets. So over time, you should earn a return from being in that business.
It's quite interesting. The point that you make is that, you know, the more money people have, even, you know, being single, that they'll go out and buy jewelry to reward themselves. Because when you think about jewelry, you think of, you know, weddings. But of course, we know that weddings now have slowed. So it seems that Richemont will benefit either way, whether people are getting married or they're staying single. So quite an interesting point there. Yes.
So I think, just coming back to Richemont very quickly, what I forgot to mention is that during the pandemic era, when people were rewarding themselves, a lot of these luxury brands had huge increases in them. You know, they increased their margins by pushing up prices. They're suffering from that now because they don't have any room to actually lower, whereas Richemont didn't do that. So they've got, they're out competing on margin as well, which is another reason why I prefer Richemont to the others.
Okay, yeah, that's very, very interesting. I also remember those times as well. Sticking with you, Ricus, let's get into telecoms. Vodacom's share has been climbing in the upward direction in the last week, but yesterday fell considerably. Can you give us some information why the fall from previous upward trend? How steep was that fall? I actually wasn't at work yesterday, so Ricus, you can fill me in.
I think it was about 5 or 6%, but that was just on its update, which was a great update.
Okay.
Specifically their business in Egypt, which did very well. So yeah, it's basically sell the news as far as I'm concerned, because there was nothing in that reporting that had any disquiet as far as I'm concerned. So just profit taking, and I can still see, even though the price has run very hard over the past 6 months, 12 months, I won't be surprised if it goes and retests. It's about 160 Rand previous high, even considering that small one-day type, you know, short-term volatility that one can expect in something that has run as hard.
Yeah, just talking about that run, Roy. I mean, has this been Vodacom specific, or has it just been a case of the whole telecoms sector rallying because of specific news in the industry?
So I think for this year, the telecom sector has rallied, and there's a variety of things that have been driving this. I think first, for all these companies that have a presence on the African continent, those countries have undergone significant devaluations of their currencies in the past 1 year. And what telecom pricing tends to do is it adjusts back to the dollar level. So your currency depreciates, you get 20, 30, 40% price increases to come through to compensate. And now that currencies have depreciated, inflation is low, and data is growing quite aggressively. So you've seen that all of these telecom companies have grown earnings. Telecom in SA has been has had a big turnaround because of the sale of SwiftNet and how they've sorted out their balance sheet, but also because of how they've been able to approach a prepaid market. So it's been the right time to be in telco companies. Typically, you avoid telco companies because highly capex intensive and they don't grow their service revenues ahead of inflation. This year, we're seeing all of them handling their capex very well, generating lots of free cash flow, and growing their service revenue ahead of inflation. So actually giving you real growth. Vodacom specifically will probably grow earnings in dollar terms over the next few years. Yes, there's a bit of a question about their competitiveness in the prepaid market, but when you put it all together, nobody else is growing earnings in the mid-teens for the level of investment for the level of returns that they're giving. So I think this is the time that the telcos can shine, and it's a time that's with us for a period. I think we're going to be here for the medium term.
Well, I mean, I think a couple of times, Roy, you've chosen Telecom as your stock pick there. Ricus, would this be a sector that you are looking at for something to buy, and maybe a specific company?
Well, I've already got Deutsche Telekom in my offshore portfolios, which I'm quite happy with. Locally, I think I'm with Roy. I'd love to buy Vodacom at lower levels and also keep Telkom in mind. Not that fond of MTN at the moment, but yeah, Vodacom, Telkom, either one of those at the correct price. I agree with Roy. I think the finance side of those businesses are really growing, and that's going to be the growth driver specifically because it's so localized as far as this continent is concerned.
Gents, let's get to more questions. The first one being on Kumba Iron Ore. Of course, it came out with a production update today and interim trading statement. The question goes, view on Kumba Iron Ore results today, and is it a buy at the current level today? I didn't really see much movement on the share price. It was a little bit in the green, actually. Roy, would you say that the markets received those numbers in good spirits? And I do note, of course, that they said that their headline earnings could vary. They could either go down or go up.
Well, the thing is, when you look at it from a production perspective, really nothing wrong. They hit their targets. There was really no problem. And I think as a good thing, the logistics side is improving. So that's a Transnet thing. So there's something to be happy there. When you look at it globally, iron ore prices have bottomed out and probably are starting to look up like other commodities. So there's nothing wrong with this one. I would say it's got a solid dividend yield. It's been through tough times, and each of the things that have caused it to struggle historically are now starting to look up. So I think it's one definitely to give a second look.
Well, it's quite interesting because, I mean, in the resources, we've really seen PGMs being leading that rally in the commodity sector that we have seen. Roy says it looks like the iron ore market has bottomed out. Do you think that maybe considering that PGM has run a lot, then maybe there could be opportunity for more upside in the iron ore counters, Ricus?
I think commodities in general, and not because I have a feeling, but you just got to take a look at what China's been doing over the past week or so, as far as their policy statements are concerned. There's a real drive in China to reduce excess in commodity supply and increase support to the industry itself to make it more efficient, which is all good news for commodities in general, because China still is your biggest market, and it's starting to reflect in share prices, whether it be Kumba or whether it be Billiton or Anglos or Glencore. That whole sector seems to be has formed a base and seems to be moving upwards, driven, I think, in part by what China is doing internally. Obviously, there's still a lot of noise surrounding tariffs, be it on copper or iron or aluminium or whatever. That's going to be part of it. But fundamentally, I think we're okay for the medium term. Only problem with Kumba is I still don't like the share price, but that's just because I look at a graph or a line on a screen. But
Yeah.
as long as you don't mind being exposed to that single commodity problem, that's always
Okay.
an issue when buying a company like Kumba, and whether you want to diversify a little bit by going into the diversified miners.
Yeah.
That depends on your risk profile. But yeah, just from a purely technical standpoint, I wouldn't be buying Kumba right now, but I think that will, considering the rest of the sector, that will probably resolve into a more positive price momentum picture.
Okay, yeah, that's also a very interesting point that you make about the one commodity thing, because yeah, we've seen the diversified miners actually talking about iron ore boosting their performances, but also copper in there. So assuming that there's much more meat in there. All right, gents, let's get to Prosus. Is there still upside to the share considering the run it has had year to date? Roy?
Well, all you have to look at is the blue sky incentive that's been given to management. I think on the stuff that they can achieve, or they should aim to achieve over the next 3 years, to believe that, yes, there probably is upside there. Tencent is growing well. The buyback is still on the go. And also all of these Just Food and all of these food delivery businesses seem to be improving, seem to be generating cash. And from that perspective, it starts looking more attractive. Clearly, that's not a business model that's been proven to be sustainable and profitable over long periods of time. But as an operating entity, I think Prosus is looking a lot better than it's been previously. There's a lot more discussion outside of Tencent that's happening. But your bottom line is, if you like Tencent, you like Prosus.
Okay, all right. On your side, Ricus, yeah, considering obviously the growth that management is forecasting and working towards, yeah, would you, but also the risk, because I mean, Roy does say Tencent is Prosus, but also it operates in China. Your view there?
Yeah, as I've mentioned many times on this program, I'm not going to disagree with anything Roy said. He makes the fundamental case for Prosus and by default Naspers operations very well. I would still be hesitant if I was a private individual in investing in Naspers, because I am not sure what the Chinese government is going to do tomorrow or next week or next year. So one has to monitor it. But at the moment, the price momentum is on your side. The fundamentals are certainly starting to push from behind, and there's no reason why either Naspers or Prosus can't advance from these levels, and just on a technical basis by at least 10 to 15%.
All right. Well, let's go to banking, and particularly Nedbank. This has declined from around 300 a few months ago. Do we think the banks may recover in the short term? If I remember correctly, I think, when was it, last month or earlier this month, Nedbank came out with an update that the market, was it? Yeah, it was Nedbank, that the market just did not like. Yes, Roy, I mean, would you be going into this particular counter considering the fact that the other banks, actually, the markets received their updates pretty well?
The thing with Nedbank is it's the one that's primarily South Africa. Its big operation is here in South Africa, and there's not much lending going on. And the problem with banks is, remember, they're highly leveraged because they've got consumer deposits which they lend out, and they need to lend to generate fees to pay their expenses, which are rising by inflation. At a time when you're not lending, you're not generating sufficient revenue to pay that back. Right now, it's a difficult time. So when you look at the banks, they're yielding, the dividend yields are very high, that's for sure. But they're not, the dividends themselves aren't growing because of the lack of lending. I think you need a bit more growth. You need a kick of growth in the economy, particularly in the corporate sector, for these guys to benefit, and for these guys to lend out and charge their fees and participate in mergers and acquisitions and the like. So I think that's why the market sold off these banks. Bond yields have come really low. Typically, that's when banks should rally. But it's very clear that the lack of growth is a problem. And that's probably why the market's not buying the banks, and specifically the ones with a big SA footprint without an African footprint that could possibly be growing.
Your take on the banking sector, Ricus?
Yeah, it's precisely what Roy has said just now. Dave Shapiro said it last night when he was asked the same question, and his answer was, well, if your economy is not growing, then the banks aren't going to lend, and that's where they have to make their money, because they can't rely just on deal making or proprietary trading if they've got that side of the business as well. In the end, they're not money, and if they're stingy in doing that, they're not going to generate interest income, and where's your dividend growth going to come from? So unless we get, and it doesn't have to be a huge improvement in the SA economy, it's going to be some improvement. Banks will struggle to increase that interest income that they have.
Well, I mean, another sector that a lot of people always say that if the economy is not growing, then that sector is also going to follow suit, is the industrial sector. So someone's asking about KAP Industrial. I bought at R4 and it's now less than half. Should I take what I have left or hang in there, Roy?
KAP's a bit of a complicated one. It's both a turnaround story, but there's also a commodity component in it, and then they have management challenges, all rolled into one.
Yeah.
So their CEO left, who's been in charge of the strategy for quite a long time. His CFO has taken over. They've just gone through this huge capex investment, and it's now excess capacity. They haven't been able to place it all domestically or internationally. And the thing is, there's also lots of little businesses inside. There's Unitrans, which is logistics. There's the mattress and all of that. So it's a difficult time for this business. It has sold off as the share price has sold off for sure. So a lot of this is in the price. But if you are going to go in right now, I mean, I think the downside is quite limited. Clearly, they have to start deleveraging to get rid of some of that downside. But to capitalize on the upside, I think you need to see some substantial changes around strategy, the direction that the business is going in, and also improving economic prospects in their key in their key industries. I mean, like Unitrans, they cut costs, they got rid of a lot of contracts, but the turnover hasn't come. It looks a lot more profitable now, but it's a much smaller business. So yeah, long story short, I think it's very cheap right now. I'm not quite sure what's going to make the share price re-rate upwards, but what I would like to see is significant delevering over the next 12 to 18 months and a change in strategy, or rather a clearer strategy that tries to capitalize on what to do with all this excess capacity that they've built up in the MDF.
All right. Well, we have run out of time, so let's get to your stock picks for today. Ricus, what are you choosing?
Google, of all things. No, not of all things. I mean, after their results and specifically if I take a look at their returning revenue growth this quarter, which I think was the highest ever, and considering their valuation versus their peers in the sectors, the Meta, the Microsoft, Google is cheap. I think it has catch up to do. It's on its way to retesting its previous high at a few months ago. It's just an absolute behemoth in not necessarily advertising, which obviously is as big as mainstream, but as far as their development AI is concerned, it's going to be difficult for us to compete with the type of expansion they're doing, the type of skill they've got, and the kind of results that they are showing at the moment.
All right. Where are you finding opportunity tonight, Roy?
I'd say the JSC itself, JSC Limited. We celebrated 100,000, was it yesterday or the day before? And that just shows you how much activity has grown, both in bonds, in derivatives, and in equities. And I think for as long as markets remain this volatile, it's the exchange that actually makes money. It's very well run. They've buttoned down their operations to a T. So as activity grows, you should see a bit of operating leverage because of excess capacity, and that should reflect in the share price over time. So I think it's an attractive entry point. I think it's a solid business, and I think it's one investors should look at more closely.
Awesome. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Mutooni from Sanlam Investments and Ricus Reeders from PSG Hole in Ruimsig. Up next, the close. Stay watching.